expected. But one result reaction that just took your breath away yesterday was the reaction from Coforge. It saw a massive rally after posting strong fourth quarter numbers. Dollar revenue grew at 7.2%, while constant currency revenue growth was at 5.1%. These are all quarter-on-quarter numbers. The company's guidance was also extremely positive. Joining us now is Sudhir Singh, Chief Executive Officer at Coforge. Good morning, Sudhir. Thank you very much indeed for joining us. I mean, 17%. The best estimate on the street was, I think, 15, if I'm not mistaken. Can you take us through why you're expecting such a strong organic 17% revenue growth?
Good morning, Lata. And the outlook that we've shared is 17% at least growth for next year. And that's essentially a function of the fact that the exit ramp at 7.1%, which is where quarter four came in, obviously creates significant momentum going in. On the deal momentum side, and we gave color and commentary yesterday in the investor call, there is a clear buoyancy that is getting reflected. And at this point in time, the order executable, which is the 12-month order executable book that we already have behind us, locked in, also gives significant support. So the guidance is at least 17% organic constant currency growth. And we've also said that SLK Global, that we acquired last month, we've acquired a 60% stake, is likely to grow higher than this and faster than this.
Okay, Mr. Singh, well, that's bullish commentary for sure coming through. And there's bullish commentary even on your margin, guidance, where barring any one-offs, ESOPs, etc., you're saying that margins will improve by 100 basis points. Now, explain this to us, because this is in an environment where, generally speaking, margins are supposed to taper off because of wage costs, perhaps, or, if travel starts resuming to some extent. So what's behind the margin guidance?
Well, it's factors that are very specific to us and to our organization. The first thing that's going to play out, which underlies the 100 bps improvement in margin that we've called out in FY22 over FY21, is the fact that the discounts in the travel business that we saw in FY21 have reversed. So that's one clear fillip. The other metric that you'll notice, which has seen a very appreciable change in the right direction for us, has been our offshoring number. The large deals that we have in the pipeline, and yesterday I did talk about the fact that we have three $50 million plus TCV large deals, one of which is a $100 million plus TCV large deal. None of these are renewals. Also have a very strong offshoring bias. So offshoring numbers have increased, and we believe we can sustain them at the higher level. Travel business discounts have very clearly gone down from our point of view. Those are two key levers. Of course, the operating leverage that we get from growth, the 17% minimum constant currency growth, is the other thing that plays in. The only last piece that I want to call out is the exit ramp, the rate, and we all recognize this, at which you enter the year, significantly lowers the bar for a firm to reach the numbers that it calls out. With a 7.1% exit ramp, all we need to clock mathematically is only 3% sequential growth for the next 4 quarters. Hence the outlook, and hence the 17% minimum that we're going for.
Sudhir, I have a couple of questions on the HR front. You all stunned us with a 967 addition to headcount. Headcount was extremely impressive. Can you guide us to some ballpark number for FY22 as well? And, this, as you go and acquire more people, would not this war for talent, as the cliche has now become common, won't that impact margins?
Lata, there is a clear war for talent, but that war for talent has been on for the last 4 or 5 months. It isn't something that's going to start at the current point in time. You're absolutely right about the numbers. Between January to March, the net headcount went up 967. So by inference, the recruitment was significantly higher than that. This quarter, the quarter that we are in, almost half of it is through. We expect to be able to repeat that performance or get fairly close to that performance in terms of net headcount addition. At this point in time, growth is really not demand constrained. It's more a function of the extent to which we can manage the supply chain, the extent to which firms have been able to already hire. Because going forward, it is going to be brutal when it comes to the talent war. So at this point in time, between January to May, current calendar year, our intent is hopefully to lock in a net headcount increase of somewhere around 16 to 1700 and hopefully add more to it in the last month of the quarter. So that's where we are, and the intent is to try to get very close to the net headcount addition numbers in Q1 as well, which is what we talked about in our investor commentary yesterday.
When you were talking to us about those big deals that you have bagged, you said there's a much larger offshoring percentage. You don't think execution could be impacted by the second?
At this point in time, we have less than 1% of our employee base in India, Lata, that's operating from office. We've had 15 months in which to fine-tune everything around connectivity to client expectations, to figuring out how to operate virtually and monitor both productivity and quality. Of course, right now, it is brutal in India in terms of the impact that it's had, personal impact that it's had on employees. But from a productivity, from maintaining an integrity of operations perspective, we feel good about the fact that we should be able to manage operations without a blip as we have over the last 15 months. There's obviously, in the second COVID wave, a lot of direct actions that the firm has taken around employee safety, which were more preventive when it came to the first wave. But second wave, we've taken more direct action. At this point in time, with less than 1% of our employees working from office, the 99% being able to produce and be productive, we feel good about the fact that the integrity of the operations will sustain.
All right, Mr. Singh, we'll leave it on that note. Thank you very much for joining in. We'll take a quick break on that note and come back with some long-term ideas with Gurmeet Chadha. Also, we'll be speaking with